All right, we are live again here on YouTube, talking Virginia, Northern Virginia rentals again. I don't know why I can't say that. As always, definitely subscribe to my channel, and I have the man, the myth, the legend, Dan Lane with the Dan Lane Rental Income Podcast. Dan, how you doing?
Doing great, Chris. Thanks for having me back.
Yeah, man. Well, let's get right into it. So last week we were talking about like rental opportunities, like maybe in the DC area, Northern Virginia area. One question that kind of kept coming up a lot was the best ways to finance a rental. And that's something that I wanted to have you back on because I know you've talked to like a bunch of different people
Mhm.
throughout the rental industry about like how to finance a rental. So let's talk about like some creative ways, like if I was like a normal person on the street, right? And I was like, I went
Mhm.
up to Bank of America and just said, "Hey, can you give me a loan on a rental property?" Like,
Right.
what would they laugh in my face, or would they say, "Yeah, here you go"? How
Well,
does?
all right. I guess like there's two main ways to finance a rental property. So if you have good credit and you have some cash, you should get just regular bank financing. That's really the best way to go. I would contact a lender that does a lot of investor loans because there's a lot of differences between getting a mortgage on a house you're going to live in and getting a rental property. So I would reach out to a lender that does a lot of investor loans and work with them. That's going to be the easiest way to do it. But if you don't have the money and you don't have the best credit, there are a bunch of creative ways that you can finance a rental property, and we can go over some of those today.
Okay, like just out of quick curiosity, like, what do you think like for like good credit or like best credit? Is that like above 710, 720, or?
I'm not sure of the actual number. The standards are always constantly changing, but I think like the mid 600s
Okay,
is
mid
probably
600s.
probably a
Okay.
good place to think. But definitely check with the lender because a lot of times like there's not hard and fast rules that maybe if you have more cash reserves, maybe they can be more flexible with the credit. So yeah, definitely reach out to a lender. And I can give you a lender if you want, if you want me to give out
Yeah, yeah.
a lender.
Yeah, we can definitely. What's a good lender that you know?
Yeah, so Chaley Ridge at Ridge Lending Group does a lot of investor loans, and she can walk you through the whole process. So I would start with her if you have good credit and if you have a down payment. That's gonna
All
be
right.
the
Well, like, yeah,
easiest.
so like we'll assume like most people, can't just walk into a bank at the moment and just get like a loan for a investment property without doing
Sure.
something creative. So let's talk about some like different creative ways. So like, what's one of the things I saw was like an assumable loan. Like, what's that?
Mhm. Okay, so there's a lot of people out there that have mortgages where you can take over their mortgage. So there's a lot of VA loans, like people that were in the military can get VA loans, and these loans are assumable. So maybe you don't have a down payment, but maybe you can just take over the person's mortgage. And
Well, that would be nice. I mean, if the person has like 2.5% interest, and right now they're
right,
at 7.
right,
Yeah.
right. So that's going to save you a lot of money. I mean, 2.5% interest versus 7% interest is a huge difference. So even if you maybe have to pay a little bit more for the property to be able to get that low interest rate, you could end up in a better spot.
So I could like find someone that maybe has a rental already or they have a property and I can say, "Hey, I want to just assume your mortgage and I guess I got to get qualified, whatever, but I get to take over at their rate that they have, which is could be probably
Exactly.
going to be better than what the rates are now." So that's
Right.
one good way.
Right. And one pro tip, and Chris, you know this, but realtors can search in the MLS for people that did VA financing when they bought their house. So if you talk to a realtor, they should be able to maybe find people that bought their house in maybe the last couple of years that did VA financing, and then you can reach out to those people and see if they're looking to move. So it's a little bit more legwork, but you can find those people and try to see if you can work out a deal to take over their mortgage.
Yeah, yeah, definitely. I can definitely help people with that. If you go to my website, chriscolgan.com, you register, I can definitely help you with that. So
Awesome.
another way, one way that I did to buy a rental, as you know, with your help, was a HELOC.
Yep.
And actually, I just had someone who's thinking about moving here from Florida their house is paid off and they want to buy a place here, and they mentioned doing a HELOC. Can you go a little bit more into that?
Yeah, this is a great strategy. This is probably one of my favorite strategies. This is something that I've personally done. There's two different ways to use a HELOC to buy a rental property. Chris, maybe you can explain what you did, and then I'll talk about the other way.
Yeah. So what I did was I have a lot of equity in my house. I've had it for a long time, and I went to. I will say with HELOCs, they're not very like a lot of banks don't do them, or they make them a little bit pain. But what I did was I went and borrowed money against my house, and then I went and was able to buy a turnkey rental, which means there was already a renter in the property and it was already managed with that HELOC money. So then I borrowed that out of my house, bought it, and then I did a refinance with Chaley Ridge there and was able to get some of my money back. So yeah, that's exactly what I did. So now I have a line of credit to buy another one if I want.
Yeah, so you can just keep on doing that. You can use your
Right.
HELOC to buy a rental property, and then once you own that property, you can get permanent financing on it, and then use your HELOC again. Another way to do it would be to use your HELOC as a down payment. So, say if you have, just to make up some numbers, if you have $100,000 HELOC, you could buy one property for $100,000, or you could use, say, $20,000 of that HELOC to use as a down payment on a $100,000 property. And then you can just keep doing that over and over again. So
Right.
you
Yeah.
can buy 5 properties with your HELOC and use it as a down payment. So
Yeah, I definitely think the HELOC's probably one of the best strategies, and also I will tell people it's a longer term strategy. Like to get approved for a HELOC and go through the process takes like 60 to 90 days. Typically, then they go out and appraise your house and all that. So definitely, like HELOC is a great way to buy a rental. Probably the best way I would think if you don't have the cash or whatever to do one.
yeah, I mean, you can keep that equity working. I mean, that equity is just sitting in your house, not doing anything. And if you can get that working for you and get that equity making money for you, I think
Right.
it's a great way to go.
All right, the next one I'm kind of smirking at because I get calls on this all the time, and I feel like there's a lot of bad information out there. But seller financing, like,
Yes.
what are your thoughts on that?
Yeah, I think this is a great strategy. What's amazing, this is an incredible number, is that 50% of the houses in this country are owned free and clear. So
What?
the people don't have a mortgage on it. And you think about it, there's a lot of older people that have owned their properties for a long time, or people that just made extra payments and got their mortgages paid off. But so there's a lot of sellers that have the ability to basically become the bank for you. So, and some sellers would actually prefer, if they're going to sell their house to you for $100,000, for example, instead of getting that check at closing for $100,000, they may prefer getting paid over a period of time. Maybe getting $1,000 a month for 100 months.
Right.
Like that might be better for them cash flow wise. So it is possible to work these deals out. It's going to take some time. It takes some more legwork to work it out, but yeah, seller financing can be a great way.
Yeah, yeah. The thing with seller finance too, you can find like title companies that know. I have known some title companies that can do the deed for you and all that, and kind of put the paperwork together. I
Yeah,
think where I was kind of smirking is I think a lot of times some of the advice out there is just go out and find a house, call a realtor and get seller financing. And all you got to remember, like the person that like lives in like the normal suburban neighborhood and this is like their primary house, they're most likely not going to be able to do seller financing for you. So it's more of like probably people that have already had a rental, or like you said, they're older and they've had a bunch of
yeah.
property or whatever.
Or
Yeah.
if you have an investor, if you're buying a property from another investor, that investor might have a big tax problem if they sell the house to you and they take the money all at once, because they may have a lot of appreciation and they're going to have a big tax bill. But if they can spread that out over a long period of time, they're going to save money, or they're going to be able to spread out their tax bill.
Yeah.
So,
Now, what about a 401k loan?
yeah, so you can borrow money from your 401k. And now I have talked to people that have actually withdrawn money from their 401k to buy rentals. And personally, I think that's kind of risky. Um, because you're going to have to pay a lot of taxes and penalties if you take that money out if you're not at retirement age. Um, but you can take a loan from your 401k. So the way that the IRS works that is you can borrow half of the money in your 401k up to $50,000. So if you have $100,000 in your 401k, you can take out 50,000. If you have $200,000 in your 401k, you can only take out 50. So fifty is the hard limit. But now you have 50 grand, you can use that as a down payment to buy a rental property. And then you can use the rent to pay back your loan. So
Yeah,
yeah,
yeah. I
yeah,
think a good strategy with that too is you borrow at the 401k, then you call someone like Ridge Lending or something, and then you get a loan. You use the 50k for the down payment, and like you said, now you're using your rent to pay back that down payment
right,
back or that 401k back. Yeah,
right.
yeah.
Yeah.
That's really actually. I've seen some people do that recently that bought new construction homes with me.
Mm.
They've used that because they require like a large down payment. So I've been seeing that a little bit more.
Yeah. Yeah,
Uh,
actually, all these strategies work great, whether you're buying an investment property or whether you're buying a personal residence. I mean, yeah, you can use all these strategies. So,
Yeah. Now, what about like private financing? 'Cause I know if you Google, private financing, like, you're going to find somebody sign a bunch of different things. Like, what about that type of stuff?
yeah, so this would be basically like the easiest way to do it would be to find maybe a family member or a friend that has some money and for whatever reason they maybe don't want to invest it in the stock market or maybe they don't have the time to learn how to buy a rental property and they they can basically loan you the money. Like they can loan you their money and you can make monthly payments to them instead of the bank. So your family member or your friend would basically become the bank. And you'd be surprised how many people have money and love the idea of investing in real estate, but they just don't have the time to do it. And they're happy just getting a monthly return.
Yeah, I guess it's good for them too, because like if you said a family or something, because they can put a note on the house or whatever. So God
Yeah.
forbid you didn't pay and they had to foreclose on, they can like do that. Yeah. What about like, is it sketchy to find like one of those like private lenders that are like 10% interest or something? It's probably not worth doing that,
Um,
huh?
no, I mean, it can work. There definitely are sketchy lenders out there, but there's also a lot of legitimate lenders out there that will loan you money on a really short-term basis at a high interest rate. Um, but if the numbers work on the deal, it can be a great way to buy a property. But it's money you want to use just for a short-term purpose, kind of the way that you used your HELOC, that you use the HELOC to buy the property, but then you refied with a traditional lender. So the hard money or private money can be great to acquire the property, but then you want to refi out as soon as you can.
All right, cool. Yeah, that makes total sense. Now, what about you? You mentioned like partnerships.
Yeah. So maybe you have a friend that has money and wants to invest in real estate, but maybe just doesn't have the time to do it. You guys could form a partnership where they could be the money partner and you could do the work. You could go out there, you could find the deals. Um, you could do whatever rehab, you could manage the property. So you're putting in your time and they're putting in their money. So it's
Yeah,
yeah,
the
so
thing I like about that too is like I said on the last call, if you're someone who can find real estate deals, you will find money because real estate it's not like a stock where you're like, hey, I think the stock is going to take off. Like real estate's tangible, it's right in front of you, it can be seen, people can get appraisal reports. So if you think you've got a good deal or you stumble into a good deal, a partnership is definitely a good way to
great way. Yep.
I never used to really believe in partnerships, but as I'm getting older here and like I'm partnering more with like people on businesses and stuff, like I feel like partnerships can definitely work.
Yeah. I mean, it can really work out great. I think the best partnerships is when people have different skill sets. So,
Right.
like, if you're able to fix up the properties and they maybe have a job where they don't have time to fix up the properties, but they want to put their money to work, I mean, that's a great partnership. And it really, I think the key is just to create a win win for everybody, where everyone is winning. I mean,
Yeah.
and you can work those deals out all day long.
Yeah. Now, what's the BRRR strategy that you told me about?
Yeah, this is one of my favorite strategies. So this is the Burr strategy. And basically what this is you're going to buy a property for way under market value. You're going to fix it up, and once you fix it up, the house is going to be worth more. And once it's worth more, you're going to be able to basically create equity. So you're going to basically create your down payment out of thin air. And if you haven't heard of this before, it sounds a little bit crazy, but it's cool. Maybe I could walk through an example of
Yeah,
how.
let's do it.
Okay, so say you have a neighborhood where the houses are selling for $400,000, and you can find a junker property that needs a lot of work. Maybe it doesn't have a kitchen, or the bathrooms aren't working. So they're not going to be able to sell it to someone using traditional financing. So you're going to maybe buy that property for say $200,000 because of the condition. And again, like that might sound crazy that someone would sell their house
Yeah, yeah.
in a $400,000 neighborhood, but people do. People do it all.
Right.
Um, so then say you're gonna put $100,000 into fixing that property up. You're gonna redo the kitchen, the bath, whatever needs to be done. You're gonna take that junker property and you're gonna make it really nice. Well, once you fixed it up, now that property is worth $400,000. So you just took a $200,000 house and turned it into a $400,000 house. So you're going to go to a bank and you're going to say, I've got this property that is worth $400,000, and I have a loan on it for $300,000. And the bank is going to say, okay, we'll give you $300,000 on this house. And then you're going to pay off the money you borrowed to buy the house and pay off the money you used to fix up the property. So now you've got this $400,000 house with no money at all in there.
Nice. I love it.
Yeah.
Yeah.
Yeah. So
That's
I mean
awesome.
that can be very confusing. I'm sure if you haven't heard of this strategy before, what I said probably makes no sense, but play that back, and it is a legitimate strategy, and a lot
Yeah,
of
play
people
it back and just keep playing it back and
yeah.
get the watch time on this video up high. Yeah, I think like for me, like if you already own a place and you've got equity, I think HELOC makes the most sense. For me, like now if you don't have that opportunity, then I would definitely call like someone like Ridge Lending or even like a banker, and be like, let's get me a strategy going to get approved and like let's see what I can do. A lot of times though, like Ridge and all them, I will say like you've got to really know like what the rent's gonna be or like the rental income, and you got to have a good guess. The one thing I like, can you explain a little bit more? Like one thing that Ridge Lending really taught me was like the 10 golden parachutes.
Mhm.
Can
Right.
you
Okay. Yeah.
Yeah, yeah.
So the the way that the financing works, so you have Fanning and Freddie that back all the mortgages. Um, and so they have a limit of 10 properties that you can get. So you're going to get your best rates and your best terms on your first 10 loans. After that, there's other ways to finance, but you're going to pay a little bit more interest. So those first 10 properties are really the most important properties, and you're going to get the best deal on it on
Right.
those properties. So
Yeah,
and
yeah. Because I
so
remember she telling me that she was telling me like, and the thing is too is like once like the one that I own, right? Like she said, you kind of get like more of like a, I guess like a score as you go up, like the more that you own rentals, because then they're like, all right, well he's had a loan, he's always paid it on time, he's always paid the
mhm,
mortgage on time, like even no matter what the rent, if the renter doesn't pay or not, and then you kind of get a better shot or a better deal once you kind of get that, for, and they can use more like for your debt to income ratio.
exactly. Yeah.
Yeah,
Yeah. So yeah, the more properties you get, the more experience you have, the better you're going to look in the eyes of the lender.
yeah.
So it's yeah, so it's good. And then if you're married, you can get 10 loans in your name, your spouse can get 10 loans in their name. So that's 20 properties right there. So
Or you do what Dan did. He put 10 loans in his wife's name, but then he made her sign where it said he got to keep all the rental
yeah,
income.
right.
Hopefully she's not watching this right
I
now.
hope not.
No, like here's the thing, right? I feel like there's really like not a bad way. Like the biggest thing I can say to people, who anybody who watches this later, is I like you got to remember the long term. This is a long term play, right? So there's really not a bad way, I think, but it's like if you can get a property and you get a good renter in there, and next thing you know, 5-10 years pass, and you're making income doing nothing, or eventually you pay the property off, and then you get the equity on top of it. That's like where the real like life changing and game changing comes in with rentals.
Yeah, I mean, it just makes so much sense. Plus, all the tax benefits you get owning rental properties. I mean, it really is, I think, a real smart way to build wealth.
Yeah, definitely.
Yeah,
Yeah, dude. Well, I appreciate your help, man. This is good insight right here.
awesome,
Yeah,
awesome.
man. If you were like, if you were somebody and you were like just starting out and you like had an opportunity, which one of these would you try first?
Um, you know, I think like the easiest way to go about it, if I had money, would be the bank financing, just because it's so
Yeah,
easy and so clean. If I had home equity, I think the HELOC is the next easiest way. Um, but partnering up with someone, doing a partnership, where I could maybe put in the time and the partner could put in the money, I think that's a great way to get going. I mean, I know people that have done that and built multi-million dollar portfolios by doing that. Um, and assumable loans is something that, with the interest rates going up, it hasn't been very common in the past, but I think assumable loans we're going to hear more about that here over the next year or so.
yeah, and actually on the partnering thing, a lot of people don't realize like you're starting to see it a little bit with like Grant Cardone and then Graham Stephan and them. That's technically what they're doing. Is they're doing like they're offering. I think I saw Meet Kevin's doing one now too. They're
Mhm.
doing like these funds on commercial property or apartment, and you're basically partnering with them, and then you're putting in a money on a partnership, and then with the hopes of like they fill it up and resell the rental or the apartment building or
Yeah.
whatever. So that's technically really what they're doing as well,
Yeah. And,
on a larger scale. Yeah.
I don't know the details of exactly what they're doing, but I mean, there's a lot of risk to that when you're giving somebody money and it's not maybe secured by a property. You,
True.
you
True.
can lose a lot of money there. Um, for me personally, I love owning properties and having the title in my name. I just don't see
Yeah. Yeah.
how I can lose actually owning properties individually over a long period of time. Like I think your odds of failure are pretty small if you buy a good property in a good neighborhood and you manage it right. I just don't see how you can lose long term.
Yeah, yeah. Guy, this richest guy I know, he always says, "Don't ever sell real estate if you
Yeah,
don't have to.
great
Like
advice.
always, don't ever sell it." And yeah, one last thing I'll tell you about is I was just reading a story recently on the Real Deal website that there was a guy that nobody really knew much about him, but he kept buying rentals in Manhattan since the 70s, and he had it and he just transferred him over. I guess he's close to passing away to his kids, and his rentals were $600 million.
Wow.
Yeah, and they said like he started buying them in the 70s and kept renting out properties in Manhattan. So
Yeah.
I'm like, yeah,
I,
so
I,
there you go, long term strategy, 50 years.
right. Right. I was born in the wrong family.
Yeah, exactly. Me too. Why is my dad buying houses in
Right.
Manhattan?
Right.
So, well, cool, dude. This has been great insight. I appreciate your time as
Awesome.
always.
Of course. Of
All right,
course.
thanks, Dan. We'll talk with you soon, man.
Okay. We'll see you.
All right, buddy.